Hello, everybody. As I figure out my streaming system here, welcome to Asymmetric Investing. Ask me anything. The idea here is to just kind of go over the things that I bought in March, give you a little bit more context in video form, maybe talk through some of the things that I'm thinking about in the market, and ask any questions that you have. This is something that's available for premium subscribers on the newsletter and then also on YouTube as well. So if you are kind of curious about how those two things work, the intention here is that everything would be kind of all in one, but that's not the way that the systems work. So for people who are video only, wanted to have something for people on YouTube as well. But that's why there's kind of a stream between the two of them. So let's start with a couple of things here, which is what I was accidentally sharing right away. And that is the stocks that I bought in March. I'll go through those first, and then I've already got a handful of questions that are in the queue. If there's anything that you want to ask live here, just put that in the chat, and I'll see those and pull those up here in just a second. But just want to go through some of these before I get to some of those questions to just give you a general idea of what I did with the portfolio this month. Remember, this is the asymmetric portfolio. I'm building this over time, $500 a month. I buy stocks basically on the first trading day of the month. That's why those buys went out before the market opened yesterday. Not trying to time the market, not trying to do anything crazy, just make those regular purchases, thinking about the long term. And I rarely sell stocks. One stock that I did sell this quarter is Celsius. One of the reasons for that, it was strange because it was a little bit poorly timed. The stock popped on Friday after earnings and then actually fell yesterday. Since, again, not trying to time the market here, but what I saw with Celsius was their acquisition of Alani Nu was actually really good and really well timed. The problem was their organic growth with the Celsius brand itself was pretty poor, and their operating margins are dropping. And so the thinking here, the original thesis behind buying Celsius was that this was technically an energy drink company, but it was actually a company that had a much bigger addressable market than traditional energy drinks like Red Bull, like Monster. Both of those, Red Bull's still private, but Monster has been a phenomenal stock over the past 20 or 30 years. So could Celsius kind of replicate some of those things? I was not in the stock, 10 years ago when it did have absolutely asymmetric potential, but it was a growth stock at that period of time. Now they've gone through a few things in these intervening years. So 2024 and early 2025, one of the things that happened is they had this distribution deal with Pepsi that when you start filling out shelves, your growth looks absolutely phenomenal. I experienced this when I was in manufacturing. I was in manufacturing for 3M making blue tape. Okay. And Home Depot was just opening stores left and right. One of the things you have to do is get product on the shelf. So you might sell a few cases of blue tape, for example, just to fill the shelf. Nobody's actually bought anything and started using it in their home yet, but you're just filling the shelves. So that's one of the things that they were doing back in these days when they were increasing their distribution. Suddenly you end up in Target and Walmart, you're just buying a ton of product to get onto shelves. And then you go through this lull because you overbuild not only in your retailers, but also in the distribution channel as well. So there's a pullback to go, hey, you know what? We're not growing at 100% year over year anymore. We're going to actually reduce these inventory levels. And that's going to make it look like revenue growth is negative, even if the end customer purchases are actually higher than they were a year ago. Okay, so that's some of the dynamic in here. Then what happened in, I believe it was spring of 2025, they acquired Alani Nu. Alani Nu is a high growth brand, but the other thing they did is they brought that into those distribution relationships with Pepsi. So that actually allowed for this phenomenal growth that you see here. The challenge is the organic growth underneath is not quite as strong, and Celsius had to give up some of their margins to incentivize those Pepsi distributors to keep pushing their product as opposed to favoring Pepsi products, for example. So that's kind of the market dynamics here. Sold this for a nice gain, about 30%. This isn't a bad company. I just think that there was better opportunities in the market today. So let's get to some of those stocks that I did buy. Took about half of what I sold and bought more Uber. Uber is one of these companies I've written about a whole bunch, done a bunch of videos on them, but I think this is clearly a company that's going to be a winner from autonomy. That's going to be able to allow them to increase supply. It's also going to make the user experience much better. I mean, like my wife, for example, doesn't like using Uber because getting in a car with a strange man in particular, not something that a lot of women want to do. So just think about these things. Maybe it's not an issue for me, might not be an issue for you if you're a viewer, but it may be an issue for somebody else. Think about kids as well. You're not putting a lot of kids into a car, but if we have autonomous vehicles and there's nobody else in the car, you may think about that a little bit differently. Maybe now a 14, 15, 16-year-old getting in the car isn't quite as strange. Those are just examples. I'm not necessarily saying that's going to be the huge market for them, but you're increasing supply because autonomous vehicles are coming to the market. I think that means that demand is going to follow. And the numbers have been phenomenal. I mean, their compound annual growth rate, this is since 2019, so since before the pandemic, compound annual growth rate is 26%. That is incredible. They've got operating margin in their favor, so their operating profit is increasing. We've gone from losses to now a steady operating profit. There's going to be some ebbs and flows in there with some of the insurance reserves. Same thing with Lyft. So there's going to be periods where your net income is going to be higher than normal or lower than normal. But I think over time, we're going to see that bottom line continue to improve. I just think that Uber sits in a really, really good position in the market today. I can go through through this one if you have any more questions, but I think the narrative that they're going to be disrupted by autonomous vehicles is just absolutely incorrect. We'll see how that one plays out, but I thought that was kind of too good to pass up where the price is today. Zeta Global is another one, relatively new to the asymmetric portfolio. Only started covering this recently, earlier this year, but again, a growth company. They're in the marketing space, and so there's a lot of questions about what is the future of digital marketing and who's actually going to be extracting value. But just look at the numbers: continuous growth, 20+% compound annual growth rate. That's what management expects through at least 2028. That's kind of the numbers that they're giving out. I think I've got, here's their targets for 2028: $2.3 billion worth of revenue. Free cash flow, $371 million. I think the price to free cash flow multiple based on that forward multiple is about 12. So the valuation should be pretty solid. But you don't often find companies that are compounding revenue at this level where you have margin expansion. So now we're getting some operating leverage in the results. What we haven't seen though is multiple expansion. And so I can pull this up here, but Zeta, their stock has not really gone much of anywhere since May 2024. Is that going to change in the near future? I think it absolutely could. The valuation is pretty compelling, at least on a forward basis, price to earnings multiple. Remember, they're just getting to that point where they're reaching an inflection point on the bottom line. 18.3 enterprise value to sales, even on a trailing basis, is just 3. That's for a company that's growing 30% on a compound annual basis over the past 3 years. So I think the valuation is attractive, as with any asymmetric investing stock. Any of these could be incorrect, but I think when you have those kinds of tailwinds behind you, you have that 10x potential in a company, especially if you get multiple expansion for a company like Zeta. So I think Uber falls into this category, sold off because software is down. Everybody thinks disruption is coming. Zeta maybe falls into that same category because you have some negative numbers from a company like Trade Desk, but really like the risk reward there. Same thing with Duolingo. Duolingo has been absolutely destroyed by the market, probably very overvalued a year or so ago. But now we're getting to the point where I think it's pretty undervalued. And one of the things, if you have the time and energy, go back and listen to the conference call from the fourth quarter of 2025. Luis von Ahn just has such a command of what this company is and what they're trying to do. Not clear that it's going to 100%, there's a 100% chance that it's going to play out, but he just understands the product that they're building, who they're trying to sell to, what the levers that he has to pull. So we could grow our monthly active users if we do this. We could monetize better if we do that. What they've shifted over the past 6 months, really, it's really been the last 2 conference calls that they talked about this a lot. They've gone from pulling that monetization lever. I can put some numbers behind this, but they've gone from pulling the monetization lever to really saying, you know what, we need to grow our monthly active users. So I'll show monthly active users, daily active users, and then paid subscribers. Let's do this let's do a trailing 12-month numbers. Put a little bit better context here. Okay, monthly active users growth has slowed over the past year. That's really, I think, if you're going to look for a red flag, this is going to be the biggest one. The top of the funnel just isn't growing the way that it was a couple of years ago. So that's something that management is saying, hey, you know what? If we want to grow and be a bigger, consistent growth company, we got to be able to grow this top of the funnel. I think there's a few ways they can do that. They, I think, need to get into teaching more things. This is something that they talked about a lot. They're also opening up some of their artificial intelligence tools. So, talking to Lily is the tool that they use with languages. That's something that's going to be coming to some of their lower price plans, potentially even to future plans that are on the free tier. So again, you're making teaching more engaging and have more people spending more time on the app, learning more things. They've added chess, math. Uh, I think they're going to be moving into other modalities in the future, but we'll see how that plays out. You know, if you're paying $10 a month for Duolingo and you only have access to learning a language, that's a relatively small market. But if you're starting to get to the point where now you can learn almost anything, that's where that real 10x potential is for Duolingo. But they need to build out those modalities. Easier said than done, but look for that to be something that expands the addressable market. Chess has been a huge success for them over the past year. I think they said that they're the number 2 chess app right now. If you haven't tried that, it's actually a really fun way to learn chess if you don't know how to play chess. But look for these things to be right now. Duolingo is in a point where there's a lot of questions about their future. Are they going to be able to grow their monthly active users? They want to be able to grow this consistently over the next few years. What they have shown is so the monthly active users is sort of top of funnel. As you start going down the funnel, daily active users continues to rise. And this is the one I think we're not paying enough attention to. In the last quarter, 2.2 million people added to the daily active user roles. And there was also a 700,000 person increase in the number of paid subscribers. So the top of the funnel isn't necessarily growing the way that you want, but the bottom of the funnel is actually doing really well. So this is not a broken business. I don't think it's a business that's going to be disrupted by artificial intelligence. I think it's just very different things using artificial intelligence to like talk to somebody, you know, have that passive voice if you're wearing something like AirPods. I don't think that's something that's going to be replacing learning a language if you're working at a restaurant in Paris, for example. Just a personal example where, you know, we're English speakers going to Paris. Everybody there spoke English because they have to. And I know that that's part of the curriculum there. But if you're, you know, in South America and you want to work at a resort or something like that, you have to know English. The reason that people learn these languages is what Louis von Ahn keeps going back to is because it's either a hobby for them or they need to learn a language to get a job. That need is not going to go away because of artificial intelligence. So I just think the company is sitting in a really good position with as sort of a leader in education apps. Price to earnings multiple. Let's look at the forward basis is about 34. So pretty low expectations, and valuation doesn't necessarily look great from that price to earnings multiple standpoint. But the enterprise value to sales is just 3. So they're sacrificing short-term profitability to make the future potentially bigger. The number that they threw out is, hey, you know, maybe we can get to $700 million in adjusted EBITDA. Well, with an enterprise value of $3.5 billion, if they got to that point, let's say they did that by 2030, that means that the enterprise value is only about 5 times that potential long-term target. Not a no-brainer. A stock that is dropping like this could continue to drop, but I like the risk reward in a company that has growth in its culture, has expansion in its culture. You don't typically lose that within a couple of quarters, and so I think Duolingo is still worth that risk reward. Not a big position in the portfolio. I think it's about 2% of my portfolio right now. So anytime we're talking about these stocks, you got to look at how much am I weighting these. These are still relatively low weight. Zeta, same thing, very low weight in the portfolio. Uber's getting a little bit bigger. I think that's 5 or 6% at this point. Hims and Hers, the controversial stock of 2026. This is one that I originally covered in 2024. So long before, it was actually before GLP-1s came out for them. I think the long-term vision of that company becoming a healthcare platform and a place that you go where your data goes automatically, that's recording information about you, helping you optimize your health long term. I think nothing has really changed about that. And all the noise, I published a bunch of content about what's going on with their patent lawsuit with Novo Nordisk. I think I did an AMA related to that as well. So that is available back in the archives if you want to go look at that. That's a lot of noise. Not saying it's not going to impact the company, not saying it's not a risk, but once we get past that, what is the company actually doing? Well, based on their quarterly results, so that came out a week ago yesterday, management said they expected to grow the company 16 to 24% in 2026. There was single digit growth in the first quarter of 2026, but that's because that was the last quarter that they could compound semaglutide and basically sell it to anyone because it was on shortage. Q2 was when those comps start getting a little bit easier because that compounding starts to come off. So what's going to end up happening is then the growth is going to be weighted to the back half of the year. So basically, even excuse me, even based on their own guidance, they're expecting 24% growth at the midpoint in the back half of the year, or back 3/4 of the year, I should say. On top of that, and maybe this is including some of that, this was what sent the stock soaring yesterday. RFK Jr. Said that peptides, 14 of 19 total peptides, are going to be moved from category 2 to category 1, meaning that a doctor can prescribe them and that they can be compounded. Does not mean that they have FDA approval the way that you would. Just a second here. Doesn't mean that you would have FDA approval the way that you would after a full medical trial and things like that. But most products are not prescribed on label, they're prescribed off label. So this would open up a potentially huge market for them as well. This is an area where they acquired a company, a peptide company, last year. So they've got the manufacturing in-house. Don't know exactly what they would be selling. Don't know exactly how much supply they have in-house. Don't know exactly what that business would look like, but look for this to be something that they're going to move into in 2026. Could be a phenomenal growth driver for them. On top of that, huge short interest in Hims and Hers stock. So again, I think the market is reading too much into the Novo Nordisk news. The fact that the FDA sent a strongly worded letter to them. This is the kind of noise that happens in business, especially for disruptive companies. I think, especially with Novo Nordisk, there's a massive incentive for both of those companies to come together and say, you know what, Novo Nordisk not doing particularly well, especially with GLP-1s. They have this new weight loss pill, the Wegovy pill. Why don't we find a way to get that on the Hims and Hers platform, get access to those 2 to 3 million subscribers? By the way, that subscriber number is before you add the potential acquisition of Eucalyptus. I think in total, you get to over 4 million subscribers once you add all the recent acquisitions. Still a lot of potential. Not without risk, but still a lot of potential. And given the drop in the stock, I did want to add at this low price. I think it was just one of those I didn't want to look back and say, you know what, my thesis was right and I just didn't have the guts to actually buy. Zillow, another one. Stock is down. I think it's about 50% right now from its high, but the business is doing well. This is exactly what we want to see from Zillow. They are growing. This is revenue in each of their segments. So residential revenue is in green, and then blue is the mortgage business. Orange is rentals. You want them to be gaining market share. They are beholden to how well is the U.S. housing market in general doing, since it's not doing particularly well, not a ton of volume going through the system. They're growing faster than that, though. So that's exactly what you want to see on the for sale, the green portion of this chart. On the other parts, they're growing phenomenally well. This is just since the end of 2023. Mortgages growing 44% on a compound annual basis. Rentals growing at 33%. The reason those two, I think, are more indicative of what I want to see of the company is I want this to be an aggregator. I want Zillow to be the place that you go when you have any questions or you're looking for any sort of housing, a rental, or to buy a home. The reason mortgages fit in there is it's probably the first thing you do. You know, I use Zillow all the time, just looking at houses around the area. But it's more than that. If we're actually serious about buying a house, the next question is, well, how much can we afford? What are we actually approved for? If you're also going to Zillow for that, that just makes that entire ecosystem much stickier. They're also building the tools to have all of these things, paying rent, closing your deal, all that stuff happening on Zillow. That's all good news. So the discount in the stock, I think, was a solid buying opportunity for investors. But again, we'll see how that one plays out. All of these ones, I just think we're looking at the Everything with asymmetric investing is looking at the risk reward for all of these companies. Okay, let's get to a few questions. And if you have any questions about the companies that I bought this month or why I sold Celsius, feel free to chime in. The first question that came in was from Steve. Asks, have you looked at Rocket Mortgage or Rocket Companies? And I have. Let me pull up their info here just a second. And I'll show you. Hopefully this will explain why I own shares of Zillow and not Rocket Companies. So I'll put my screen up here again. So this is Rocket Companies. They recently acquired Redfin, so they're trying to vertically integrate a little bit, but most of their business is things like Rocket Mortgage, so being a mortgage lender, and then providing property insurance, valuation, settlement, all those kinds of things. So home-related stuff. First thing I do whenever I look at a company, and they do have credit losses, so that's something to keep in mind. But I want to just go in and I want to just look super high level. What do their finances look like? This is net income to common shareholders. Not really a consistent growth company. Also, not profitable in the past year. We're not seeing operating leverage. If you look at, remember that Zeta chart where you go from, or even Uber, where you go from losing money to consistently going back to the point where your operating profit is going positive. That's the kind of thing that you want to see from a company like Rocket Companies, and it's not what we're seeing. The other question that I have from them as a company is there an aggregation play or a platform play for them? Meaning, Zillow is maybe the best example here because it's the same business. Zillow is just a place that you go to look for housing stuff, and now it's a place you go to look for rental stuff. So the way that you would measure their success and failure, at least from a usage standpoint, would be eyeballs. Web page views. They always put this market share data chart on their earnings report. Does that same thing translate to Rocket Companies? If you're going to look for a mortgage, you're going to do that once. You're probably not going to do it again for another 10 years, 15 years. So that's not really the same kind of thing where that relationship with them is an ongoing relationship where you're constantly opening Zillow. Same thing with realtors. We went and looked at a house about a year ago, and the realtor brought up Zillow because they were looking for information on the house, like the last time it was sold or something like that. Because that information, that's where they go. So I think this is just what I struggle with strategically with Rocket Companies is what is their differentiation in the market? And if I don't understand that, and we're getting to the point where they're not showing that net income profitability, that's where I really struggle with a business like that. They also buying Redfin just seemed like they needed to buy a company. But again, Redfin is being disrupted by a company like Zillow. Redfin is a broker. And what they need to have is more people buying homes with brokers. And I don't really think that in the 6% fee, I know that Redfin does their fees a little bit differently. I don't think that that's necessarily the future of the housing market. I want to be disrupting the housing market, and being a digital platform like Zillow has, I think is a much more attractive position. Doesn't necessarily mean that that's going to win out, but that's where the 10x opportunity is, as opposed to maybe buying a stock that's a good value but doesn't have quite the same upside. Okay, Austin asked a few questions here. I'm gonna read the whole thing here, but I'll put up at least the beginning. I couldn't quite show the whole question. Hims and Hers Management recent comments emphasizing daily active user growth, or sorry, Duolingo's management. I have these ordered differently. Okay, I'll go with the Hims and Hers. Has guided to at least 6.5 billion in revenue and 1.3 billion in adjusted EBITDA in 2030. I believe management reiterated this. Yes, they did reiterate that on their most recent earnings report. How realistic do you think those targets are if they achieve that scale? What valuation multiple would you have based on the 2030 numbers, based on this guidance? Even if using fairly conservative multiple and discount rate, the stock appears potentially undervalued. Am I looking this correctly? Okay, so 6.5 billion and 1.3. Let's pull up Hims and Hers info here. We'll just try to walk through this. Okay. Currently, market cap $3.8 billion, enterprise value $4.3 billion. So if they do get to the point where they're doing $6.5 billion worth of sales in 2030, you would think they would be trading for more than 2 times sales. That would be a pretty good return just there. That's a $12 billion, $13 billion company. How profitable are they if they get to that point? I know that let's see, the number that they had was $1.3 billion in adjusted EBITDA. But let's actually look at, so let's pull revenue. Let's do operating income and then free cash flow. Free cash flow is going to pull out things like stock-based compensation, so it's going to be a little bit different. But one of the things that growth is a weird thing. Growth is the hardest thing to price as any investor because there's no model that really does 67% compound annual growth rate really well. Let's say peptides does do really well and become, longevity and labs becomes a really big business for Hims and Hers. Why is this not a, $10 billion, $20 billion a year company? Well, if you're doing a 50, 60, 70% growth rate, that's really hard to model what that company should look like from a valuation perspective. So that's why I often use price to sales as a more meaningful metric for some of these growth companies, because it at least gives you a proxy for, okay, how does this compare to other growth companies? Because typically companies that are growing this quickly are not focused on margins. They're not focused on, I got to squeeze every dollar I can. So even the operating profit, $105.6 million. Let's just pull in that margin number, 4.5%. So you're getting operating leverage on the margin, but we're not at the point where they're going to start really pulling that lever and going, you know what, we want to be at a 20% operating margin, a 30% operating margin. They're just nowhere near that point yet. Free cash flow also positive. So yes, Austin, I think you're right. The right way to think of it is if they hit those numbers, which the market does not think they're going to. Let's I can pull in estimates here. These are annual numbers for revenue. 2028, the mean analysts think is $3.7 billion worth of revenue. And not expecting much growth at all, $2.7 billion in 2026. So only adding $1 billion worth of revenue between 2026 and 2028. So the market is obviously does not think that they're going to be able to hit these numbers. But if they do, then you are looking at a company that deserves to be trading for much more than 2 times sales. What are some growth companies out there? Well, Hims and Hers actually growing faster than Palantir. Palantir trades for 76 times sales. Not saying that that's the correct multiple, but that's what they trade for. Let's look at another one in the portfolio, Robinhood. They don't have this. Here's the price to sales. Right now it's about 15, and it was previously 25 or 30. So again, even when you look at Hims and Hers, I think the way that you have to look at it is, are they going to grow revenue? Are they going to be able to expand margins? And is there multiple tailwinds? And the fact that I think you have all three, you even have the potential for buybacks. I think they announced a $400 million buyback in the most recent quarter. You could have a falling share count, a company that's growing in excess of 30% compounded each year over the next 5-10 years, a company that can expand their margins, and a company that goes from 1.8 times sales to 10 times sales to 20 times sales. Add all those things up, and this is why I'm excited about the stock. Again, there is risk in Hims and Hers stock, but if the idea is we're looking for companies that have the potential for 10x returns, for 100x returns, Hims and Hers hits that. All right, let's go back to Duolingo, which I messed up here in a second ago. Based on Duolingo's recent comments emphasizing daily active user growth and the bigger prize, they suggested the business could reach 2.5 billion in revenue and over $700 million in adjusted EBITDA in the next couple of years. Given that outlook, what would be a reasonable valuation multiple for Duolingo in a few years? Do you think the company can reaccelerate revenue and margin growth to support that valuation? This is ultimately the big question behind Duolingo. So let's say that they do hit those numbers. Let's just pull up what they're actually doing right now. Okay, so here's what things look like right now. $1.0 billion. Just pulling in the. I had some issues with Duolingo earlier this week, so that's why I was wondering if it was actually the. Okay. I'm not sure what the final quarter is here for this, if this is quite correct, but you're looking at potentially revenue growth of, and they didn't give a time frame, but more than doubling revenue and increasing their adjusted EBITDA. It looks like about double from here. What is a reasonable multiple to pay for that? Again, I think what it would depend on is once you get to that point, are you still growing? Is the pie continuing to get bigger? And if it is, you have $700 million in adjusted EBITDA. There's no reason that that can't trade for 10, 20 times adjusted EBITDA. But if it's not growing and you get to 700, then you're just at the point where, okay, maybe you get a good return. Let's say it trades for 10 times. That would be a double from here, from an enterprise value perspective. That could be a good stock, but not a phenomenal stock. So I think the question is, if they actually get to, let's say they hit those numbers in 2029. If you're going from $300 million in adjusted EBITDA today to $700 million in 2029, then what are your goals for 2032 or 2033? $1 billion, $1.5 billion in adjusted EBITDA? That's where I try not to focus too much on that valuation. It's just a matter of, okay, are they going to be able to turn this around? Are they going to be able to get those monthly active user numbers growing again, daily active users continuing to grow, expand their product, make that subscription much more attractive for people who are trying to learn anything, and then let the numbers kind of follow. And the what I use for those guidances is, do I think the stock is cheap if they do that, or even better? And I think that's where we're at with Duolingo is, hey, if they hit $700 million in adjusted EBITDA 3 years from now, and the fact that they did that shows that they're growing the business, now we should trade for a much higher multiple. And so that's where it's not a no-brainer price today, even though shares are down 80% from their high. It's not a no-brainer price today, but I think it's much more attractive today than it was. And the fact that they have over $1 billion, $1.1 billion worth of cash on the balance sheet is something shouldn't go overlooked as well. Okay, another question. I haven't historically used price to free cash flow as a primary valuation metric. How do you think about the appropriate price to free cash flow multiples for high growth companies versus slower growth companies and more mature businesses? For example, do you have a framework around your Zeta purchase? Price to free cash flow is not a very good metric for growth companies typically, because they're focusing on growth. They're not focused on cash flow. So, think about a company like Zeta or Hims and Hers. If you have, let's say you have $100 million in cash flow coming in, well, you could keep that cash flow, or you could invest it in the business. And when I say investing it in the business, I mean spending it on SG&A expenses or R&D expenses. So SG&A would be things like marketing, sales, or R&D expenses, making your products better, buying a competitor, building out capital equipment. That's going to come out of free cash flow. So if you're not a mature business, looking at a company that is based on price to free cash flow is probably not the best metric. The one company that I do look at that on is MGM in the portfolio. You could also look at a company like Alphabet, despite the fact that they continue to grow like crazy. You can look at that price to free cash flow. Lyft, I guess I also use price to free cash flow. Although that's a little bit volatile what I do in those senses in those areas is go, okay, we're getting a pretty good valuation on a price to free cash flow metric, trading for let's say 10, 11, 12 times free cash flow. But I think that there's more growth out there than the market does. So a company like Lyft trading for 11 times free cash flow, you're going, wait, what does the market actually think? The market thinks that Lyft is screwed long term and that they're going to be disrupted, that they're going to still be that second fiddle to Uber. Well, that's my baseline is that at least I've got a good valuation. And if that upside scenario plays out and now the multiples start to go up, now suddenly you get a stock that doubles, triples, quadruples in value pretty quickly as as the market re-rates that kind of an investment. But typically for growth companies looking at earnings or looking at free cash flow, probably not the best metrics to be looking at because you want them to be focusing on revenue growth, not on earnings growth. Okay, final one. Would love your perspective on investing across mega caps, small caps. For example, how would you compare allocating capital to a $160 billion company like Uber versus a $3 to $4 billion company like Hims and Hers? I don't think about the market capitalization all that much when I'm looking at the allocation of the portfolio. And I've taken some portfolio management classes and there's a lot of theory behind portfolio management. I think there's one, you don't want to be overly concentrated. I don't think you want to be overly concentrated in any position, in any specific position, at least with what you put in for your capital. So the kind of ballpark that I've said is I don't want to put more than 10% of my capital in the asymmetric portfolio into any one given stock. I will let that stock grow to be more than 10%, which has happened with Robinhood. It has happened with Spotify, and it has also happened now with Alphabet. But that's the point. The point is if you have a 10 bagger, a 100 bagger, you don't want to sell it. So I'll let those companies grow to higher valuations. But buying them, I think it's more about what is the risk reward of that specific stock and what is my comfort how comfortable am I with the portfolio overall. So I'm looking at the valuation of each of those companies, but it's really no different whether you're looking at a $160 billion company or a $3 or $4 billion company. What is the market that they're growing into? Autonomy could make Uber's addressable market 10 times bigger or more. Hims and Hers, the medical market is well more than 10 times bigger than their current revenue in the entire telehealth business. So the upside potential is tremendous. Doesn't necessarily mean that I want to favor one over the other because the risk at Hims and Hers is just significantly higher than Uber. There's millions and millions of people using Uber, billions of miles traveled on Uber. Not the same thing for Hims and Hers. So right now I've kind of overweighted on some of these bigger companies, but that's not really intentional. But maybe I guess if I'm to look at the portfolio and say, where does it usually play out? Because it usually kind of plays out like that. And then over time, if some of these 3, 4, 10, $20 billion companies become much, much bigger companies, they will grow to a bigger size in the portfolio. The other thing that I just generally do, and I share on the asymmetric portfolio site, which I need to update with the buys from yesterday. I will get that done today. There's an image of the heat map and the allocation of the portfolio overall. And what I try to do there is just a check of, am I comfortable with this? Do I think I'm over allocated to one company or one industry or one theme, if you will? There was a while there that cryptocurrencies were a real tailwind for the asymmetric portfolio, despite the fact that really the only direct crypto stock that I have is Coinbase. And that's even, a little bit more tangential than just owning a cryptocurrency. but Robinhood had tailwinds, SoFi had tailwinds, Coinbase obviously had tailwinds. And so there was a bunch of gains in 2025 that were related to cryptocurrencies, despite the fact that this wasn't necessarily central to the thesis that I had with any of those companies. But that would be kind of the way that I typically look at it. I know that's probably a little bit unsatisfying, but I typically look at the portfolio and go, am I comfortable with where we're at here? If I'm wrong on this one specific stock, am I going to regret it? Thing that I have said over and over again, if you're right, a little is enough. And if you're wrong, a little is all you want. So with any of these companies, I may be wrong. Any of us can be wrong about any of these investments for a number of different reasons. There's a question that came in, an update on Thrive. A lot has happened in the past month. Yet your picks for March are doubling down on existing picks. If you had to pick a new stock or two, what would they be? I don't add stocks to the portfolio all that often because I do want to be picky. So most of my buys are going to be doubling down on the existing portfolio. It's just the way that the way that I build this entire service is, when I cover a stock, it goes into what I think of as the asymmetric universe of stocks. And then each month I'm just picking from that universe. What that forces me to do is not chase after the shiny object that looks really cheap right now. So the Trade Desk would be one that is on my radar, but I haven't gone after that. So I want to be able to write a 3,000 word thesis on here's what's going on with this company. Here's why I like it long term. Here's why it's a potential 10 bagger over the next 10 years. And there's just not a lot of companies that end up falling into that category. So that's why there's, I think, 24 or 25 stocks right now in the portfolio that will grow or shrink a little bit over time. But that's why it may look like I'm doubling down on all these companies, because that's what I'm doing. I'm just allocating to the companies that are in the portfolio. Update on Thrive. Thrive is Thrive is going through an interesting transition, going away from basically the yellow pages. It's their old marketing business, and that is the intention is that that's going to cash flow the business that they, or the debt that they have, pay off that debt, and they're going to be able to grow their SaaS business. So they had earnings late last week, if I remember correctly, and the numbers weren't great and the guidance wasn't great. I have not written about it yet, but I actually intended to over the weekend, asking the question, did I make a mistake on Thrive? And I listened to their conference call, and I want to give myself a little bit more time to process what they're doing. It's a very, very small position in the portfolio. I've only bought stock in Thrive once, so 1 month. So it's probably less than 1% of the portfolio right now. But it does have a lot of the characteristics that I like. But we're at this point where the market is, anything that the market is seeing in relation to missing your numbers, missing guidance, indicating there may be a threat from artificial intelligence in particular, is just getting absolutely obliterated. I mean, MongoDB, I think, is down 25% today or something like that. There's a critical infrastructure company that's just getting destroyed. So I don't want to overreact to one quarter, I think is what I'm getting at with that. I'm going to cover them a little bit more in the future and kind of lay out, here's what I think about them. Here's what I need to see from them. But here's an example of a company that actually worked out really well, that I went through this same thing. And that's Figs. So I wrote an article about Figs for this past weekend. That stock is up 130%. Now, actually, I think more than that. I think they had a good day yesterday in the asymmetric portfolio. And the reason is, the thesis when I bought the stock has played out pretty well. But getting there was not a straight line. It was not, here's my thesis, the next quarter, yep, thesis plays out. The next quarter, yep, doubling down. It was actually, things were going in the opposite direction. They were doing things that I didn't necessarily like. They invested in their former co-founders, or I guess their co-founders startup. That I didn't love. Their sales were kind of meh. They were having to do discounting. They kind of changed their marketing strategy a little bit. And then it was like suddenly everything flipped in the fourth quarter of 2025. Nurses started buying clothes again, after, years of maybe overstocking during the pandemic. They moved into other markets. They've added products. They've moved into more international markets. And a lot of that stuff just suddenly hit. And the thesis way back when I originally bought the stock ended up being right, but I think I was down over 50% in that stock in a relatively short period of time. It's possible the same thing happens with Thrive. So I want to give it a little bit of time, but I'll cover it a little bit in a little bit more depth when I fully wrap my head around it, because I'm I'm of many minds, I think, right now when it comes to Thrive. Um, okay, Joel says, I can't see the chat on the video. Is that my problem on your end? Don't know. I'm not seeing questions come in, but if you want to answer in here, let me know which feed you are um, on the premium side on the Asymmetric Investing channel or through the newsletter. And I may have a setting incorrect. But the question about Duolingo: if chess is growing so much, what prevents Duolingo from getting into the how to use AI training models? I find people either using AI like an advanced browser or a specific app. Education in this area seems ripe. Yeah. I mean, there's an example. I think if you're the Duolingo team trying to figure out what modalities do you move into next, it's almost a question of you could do everything. The teaching AI side, my only push back on that would be, what differentiation does Duolingo have versus anybody else? Because you could go on YouTube right now and look at and find 1,000 videos of how to use AI. I don't know that Duolingo necessarily brings anything to the market that some of those maybe more smaller, more nimble companies aren't able to do. But think about everything that, you know, kids learn, everything that you want to learn as an adult. Maybe it's artificial intelligence, but finances. That even could be a potential win for them. There's just a lot of different areas that they could grow. I don't know what the right answer is, but I wouldn't have chosen chess either. So that has obviously been a huge hit for them. They do a ton of A/B testing. That's one of the things. If you listen to their conference calls, they talk about all the A/B testing that they do. But I'm sure they're going to be building out modalities and testing out and seeing what works with especially with their kind of style, right? It's like kind of more gamified style. Maybe isn't the best for artificial intelligence. I don't know, but yeah, it's a good question. What are they going to come out with next? I don't have a great answer for that. But hopefully it's something soon, because I think that's where it's one of these subscriptions where it would make a ton of sense for our family to be able to go, okay, we need access for everybody to have Duolingo, because my daughter's learning to read. She's learning math. My son's a little bit more advanced, but he can probably still do things on Duolingo. He's using all kinds of different tools on his iPad now. My youngest is not quite at that point, but music could be really fun. That's another thing that they're going to be moving into probably more and more in 2026. But yeah, what are those modalities? I don't have the answer for that. But look for that in 2026. They've got to add them. They've got to start adding those modalities. Otherwise, my thesis on that company that this is going to be a much more of an education platform and have a lot more different products under one subscription price, then it, maybe I'm wrong about that, but we'll see how that plays out. Okay. That gets through all of our questions. Thank you everybody for watching. I will check out if I have some setting wrong for the chat. So hopefully I can fix that in the future. But thanks everybody for being a subscriber. Let me know anytime if you want to comment on any of the articles that I have or any YouTube videos. Feel free to do that. I try to get to as many of those as I possibly can. So appreciate everybody so much. Have a good day. We'll see you next time.